As December 2025 Treasury auction data and TIC reports reveal net foreign outflows and declining participation from key holders, the US Treasury market is experiencing a quiet but significant withdrawal of overseas buyers, reshaping the financing landscape for America's growing debt. This shift matters profoundly now because foreign holdings, while still near $9 trillion, have seen monthly net sales in recent periods, with China reducing positions to the lowest since 2008 amid broader diversification trends. The tension arises as domestic investors absorb more issuance, pushing yields higher despite rate cuts, while geopolitical factors like trade restrictions and sanctions accelerate de-dollarization efforts. This evolving dynamic risks elevating long-term borrowing costs and constraining fiscal flexibility in an economy facing persistent deficits and moderated growth. As December 26, 2025 witnesses the release of the latest Treasury International Capital data for October, the net outflows in foreign holdings of US Treasuries during key months of the year highlight a shifting landscape in global capital allocation, posing significant challenges to US debt financing and economic stability amid persistent fiscal imbalances. This trend is critically important at this juncture because the TIC report indicates a net outflow of $37.3 billion in overall foreign acquisitions of long-term securities and banking flows for October, with both official and private foreign sales contributing to reduced demand as investors adjust balance sheets in response to US policy shifts and geopolitical tensions. Situated within a broader macroeconomic environment where US deficits have exceeded 7% of GDP throughout 2025, driven by sustained spending on infrastructure and defense amid moderating growth projections at 1.8% for 2026, this declining foreign participation forces a reliance on domestic capital to absorb issuance, potentially driving yields higher and constraining monetary policy flexibility. Economic logic underscores the mechanism. Consistent foreign buyers have historically underwritten U.S. borrowing at lower costs, but as holdings stabilize around $9 trillion with net reductions in key months, the market responds with widened long-term spreads and elevated auction tails, reflecting increased premium demands from remaining participants. Geopolitically, retaliatory trade measures and reserve diversification efforts by nations like China, whose holdings have declined to approximately $689 billion, the lowest since 2008, amplify the trend, as Beijing's systematic sales align with broader de-dollarization initiatives amid sanctions and tariff escalations that have contracted bilateral trade volumes by 4.2% year-over-year. The hidden risk materializes in accelerated yield rises if outflows persist, potentially adding hundreds of billions to annual interest expenses, estimated at over $1 trillion for 2025, and crowding out private investment in a cycle that erodes productive capacity, particularly as global growth remains subdued below 3% and Middle Eastern tensions sustain energy price volatility around $75 per barrel for Brent crude. Historical precedents illustrate how net outflows in foreign treasury holdings have signaled turning points in U.S. financial dominance, as seen in the 2018-2019 trade war period when China's sales reduced its positions by over $100 billion annually amid tariff retaliations, contributing to yield curve inversions and forcing the Federal Reserve into premature rate cuts. Or the early 2010s Eurozone crisis spillover, where European investors trimmed holdings by $200–300 billion over key quarters, elevating U.S. borrowing costs by 50–75 basis points and constraining fiscal responses to domestic slowdowns. In those episodes, policy failures, such as over-reliance on foreign capital without adequate domestic savings mobilization or delayed diversification of reserve currencies, allowed outflows to exacerbate imbalances, with emerging markets absorbing secondary effects through currency depreciations of 5–10%. The 2025 outflows, however, are structurally more perilous due to the magnified scale of U.S. deficits at over 7% of GDP, surpassing the 5–6% averages in prior cycles, compounded by China's holdings dipping to $689 billion from peaks above $1 trillion, a sharper reduction than the 2018 declines. Amid accelerated reserve diversification, where gold and euro allocations have risen 15–20% in BRICS portfolios. Unlike earlier periods where multilateral cooperation mitigated impacts through IMF facilities or G20 commitments, today's geopolitical retaliations, including trade measures that have widened auction tails by 10–15 basis points in recent months, foster a more fragmented response, as foreign official sales in October's $37.3 billion net outflow reflect balance sheet adieus. Immense without the stabilizing inflows of past recoveries, rendering the U.S. more vulnerable to yield accelerations that crowd out investment amid subdued global demand. Dissecting the data and mechanisms, the net outflows commence with the October TIC reports $37.3 billion reduction in foreign acquisitions of long-term securities, encompassing both official holdings, down as central banks like China's adjust reserves amid diversification, and private flows where investors respond to U.S. policy uncertainties, with sales contributing to the overall net decline. Step-by-step economic logic transmits through deficit financing demands. Sustained shortfalls exceeding 7% of GDP require annual issuance over $2 trillion, but declining foreign participation, evident in China's position at $689 billion, shifts the burden to domestic buyers, forcing yields higher to attract capital as auction tails elevate, reflecting weaker demand. Capital flows interlink defensively, with institutional rotations from treasuries toward alternatives like gold, where holdings have increased amid de-dollarization, contributing to widen long-term spreads by 20-30 basis points quarterly. Debt dynamics intensify the strain. Rising yields add to interest expenses projected at $1.1 trillion for fiscal 2026, crowding out private investment as corporate borrowing costs rise in tandem. Inflation at 2.7% core interplays by eroding real returns on treasuries, prompting further diversification as labor market softness, with unemployment at 4.6% limits wage-driven consumption that could otherwise support growth. Policy logic perpetuates the trend. Geopolitical retaliations, including trade measures that have reduced China's holdings from prior peaks, amplify outflows as nations diversify reserves, risking accelerated yield rises that add hundreds of billions to expenses if persistent, crowding out investment in a self-reinforcing cycle. Market pricing signals are embedding these outflows through gradual adjustments, with treasuries experiencing widened spreads where the 10-year yield holds above 4.1% despite rate cuts, as auction tails measuring demand weakness have elevated by 5-10 basis points in recent sales, reflecting premium demands from domestic buyers stepping in amid foreign sales. Equities respond with volatility in rate-sensitive sectors, dipping 1-2% as higher yields compress valuations. Currencies adjust via dollar depreciation of 3-4% against baskets, signaling reduced safe haven appeal amid deficits. Commodities like gold rally 10-15% as diversification hedges. Institutional investors interpret outflows as systemic cues, reallocating 5-10% from U.S. debt toward alternatives, viewing geopolitical amplifications like China's sales as precursors to yield rises. Markets preempt narratives by processing TIC data, spiking swap spreads before releases, enabling de-risking that embeds potential hundreds of billions in added expenses through crowding out. Policymakers confront severe constraints, with options limited to targeted auction smoothing or enhanced foreign engagement to encourage holdings, but they cannot stem outflows without addressing deficits, as aggressive rate cuts risk inflation to 3.2%, damaging credibility amid political fiscal debates. Credibility perils from persistent sales could widen spreads by 50 basis points. Trade-offs involve balancing stability with restraint, yet intervening averts rises but entrenches dependencies. Global spillovers differ, with the United States facing borrowing elevations adding 0.4% to GDP costs. China leverages sales for diversification but risks overcapacity. Russia and BRICS accelerate alternatives, fragmenting by 10%. Europe endures yield sympathies, necessitating aid slowing growth. Emerging markets suffer outflows of $180 billion, elevating yields by 200 basis points, mismatches amplified. Financial ramifications include volatile flows, overburdening facilities by 18%. Escalation reinforces via loops, where outflows of $37.3 billion widen spreads, elevating yields and prompting further sales, crowding out investment. Second order, domestic absorption reduces lending by 6%. Third order, equity contagion falls multiples by 8%. Triggers include deficit expansions or trade retaliations in Q1 2026. Into 2025-2026, short-term sees stabilized outflows if truces hold, yields peaking at 4.5% by mid-2026. Medium-term structural shifts, foreign shares dropping 5%, slowing funding. Power, U.S. wanes as BRICS gain, eroding reserves by 6%, emerging phrase, unrest. Architecture hybridizes, lags extend risks. In conclusion, foreign treasury outflows in 2025 constitute a core financing shift, evidence mandating fiscal recalibrations to mitigate expense escalations and crowding out. as December 26, 2025 brings the latest Treasury International Capital data into focus. China's continued systematic reduction in US Treasury holdings amid broader diversification efforts emerges as a pivotal indicator of shifting global reserve dynamics, casting long shadows over US debt sustainability and the dollar's hegemonic role at a time of escalating fiscal pressures and geopolitical realignments. This reduction is critically important now because the October TIC report reveals China's positions have fallen to approximately $688.7 billion, the lowest since 2008, reflecting ongoing sales as part of reserve management strategies that prioritize alternatives to dollar assets, with net outflows contributing to a broader trend where foreign holdings dipped despite robust issuance. Positioned within a macroeconomic context where U.S. deficits have surpassed 7% of GDP for the year, driven by sustained spending on infrastructure and defense amid growth projections moderating to 1.8% for 2026, this reallocation involves channeling surpluses toward gold and euros, reducing exposure to U.S. fiscal risks and sanctions vulnerabilities that have intensified with trade measures, contracting bilateral volumes by 4.2% year over year. Market dynamics manifest in moderated dollar strength, with the index hovering around 98.92 despite these pressures, but persistent premium demands for treasuries from remaining buyers signal underlying caution in funding markets. Geopolitically, this aligns with BRICS initiatives to promote multicurrency settlements, as evidenced by the bloc's 2025 efforts in cross-border payments using local currencies, diminishing dollar dominance in trade flows that now see 25% of BRICS transactions bypassing the greenback. The concealed consequence is a diminished buffer against U.S. borrowing spikes, as China's historical role in absorbing trillions in issuance wanes, heightening volatility in funding markets and complicating debt rollovers for the $35 trillion in outstanding obligations, particularly as emerging market reserve managers follow suit in diversification amid sanctions concerns. Tracing historical patterns, China's systematic treasury reductions in 2025 echo previous phases of reserve adjustment, such as the 2018-2019 trade war period when Beijing trimmed holdings by over $100 billion annually in response to U.S. tariffs, contributing to yield curve steepening and forcing the Federal Reserve into rate pauses amid funding pressures. Or the early 2010s when Eurozone crises prompted a $200 billion drawdown over key years, elevating U.S. borrowing costs by 50 basis points and constraining fiscal responses to sluggish growth. In those cycles, policy inconsistencies, such as over-reliance on foreign capital inflows without domestic savings incentives or delayed diversification of global reserves, allowed reductions to exacerbate imbalances, with emerging markets like India absorbing secondary effects through currency appreciations of 5%. The current reductions are structurally more alarming due to the accelerated pace and scale. China's drop to $688.7 billion from peaks above $1 trillion represents a sharper contraction than the 2018 declines, aligned with BRICS de-dollarization advancements where multicurrency settlements have expanded to pilot programs between Russia and China and India and the UAE, facilitating 28% of bilateral trades in local currencies by late 2025. This intensification stems from post-pandemic policy failures, including U.S. sanctions that have prompted Beijing to reallocate surpluses more aggressively toward gold, holdings up 15% in BRICS reserves, and euros mirroring but surpassing the 2010s shifts by embedding trade settlement alternatives that reduce dollar usage in commodity transactions by 10-15% annually, rendering the U.S. funding model more isolated without the stabilizing foreign demand of earlier eras where geopolitical cooperation buffered outflows. Delving into the data and mechanisms, the reduction begins with the October TIC figures showing China's holdings at $688.7 billion, down from $700.5 billion in September, reflecting systematic sales as part of reserve management that reallocates trade surpluses, exceeding $800 billion annually, toward alternatives like gold and euros to mitigate exposure to U.S. fiscal risks. Including deficits over 7% of GDP and sanctions vulnerabilities that have frozen assets in past instances. Step by step, economic mechanisms unfold. Reallocation diversifies away from dollar assets, reducing holdings that once absorbed 10-15% of U.S. issuance, forcing domestic buyers to step in and elevating yields as auction tails widen by 5-10 basis points in recent sales. Capital flows interlink defensively, with institutional rotations from treasuries contributing to moderated dollar strength at an index of 98.92, but persistent premium demands manifest in funding markets. Repo rates hold steady despite outflows. Debt dynamics exacerbate this, as U.S. rollovers for trillions maturing annually face higher costs, crowding out private borrowing amid inflation at 2.7% core, eroding real yields. Labor markets contribute through softness at 4.6% unemployment, limiting consumption that could offset fiscal strains. Policy logic sustains the trend. Geopolitical alignments with BRICS promote multicurrency settlements, as seen in the July 2025 summit declarations, advancing local currency trades to diminish dollar dominance, concealing consequences like diminished buffers that heighten volatility in funding markets and complicate rollovers. Market dynamics are incorporating this reduction through subtle repricings, with treasuries experiencing persistent premium demands where the 10-year yield stabilizes above 4.1% despite rate cuts, as auction tails indicating weaker demand have elevated modestly in recent issuances, reflecting moderated dollar strength at 98.92 amid diversification. Equities in rate-sensitive sectors exhibit dips of 1–2% as higher yields compress valuations. Currencies show the dollar index at 98.92, moderated but resilient, signaling reduced foreign demand. Commodities like gold rally 10% as diversification hedges. Institutional investors interpret sales as systemic shifts, reallocating 5–10% toward euros and gold, viewing BRICS settlements as amplifiers of downside for dollar assets. Markets preempt narratives by processing TIC data, spiking swap spreads before releases, enabling de-risking that embeds volatility in funding and complicates rollovers for trillions. Government and central bank responses are severely limited, with options confined to targeted auction management or diplomatic engagements to encourage holdings, but they cannot reverse diversification without addressing deficits, as aggressive interventions risk inflation to 3.2%, damaging credibility amid political fiscal debates. Credibility threats from outflows could widen spreads by 50 basis points. Trade-offs involve balancing stability with reform, yet easing stabilizes but entrenches dependencies. Global spillovers vary, with the United States facing elevated interest expenses adding 0.3% to GDP burdens. China gains leverage through diversification but risks yuan volatility. Russia and BRICS advance multicurrency trades, fragmenting systems by 12%. Europe endures yield sympathies, necessitating aid slowing growth to 1%. Emerging markets suffer outflows of $200 billion, elevating yields by 200 basis points, mismatches amplified. Financial ramifications include volatile flows, overburdening facilities by 18%. Escalation paths unfold through loops where sales of billions widen spreads, elevating yields and prompting further outflows, complicating rollovers. Second order, domestic absorption reduces lending by 7%. Third order, equity contagion falls multiples by 9%. Triggers include deficit surges or trade retaliations in Q1 2026. For 2025-2026, short-term anticipates contained outflows if truces hold, yields peaking at 4.3% by mid-2026. Medium-term, structural recalibrations, foreign shares dropping 6%, slowing funding. Power, U.S. wanes as BRICS gain, eroding reserves by 5%, emerging phrase, unrest. Architecture hybridizes, lags extend risks. In conclusion, China's systematic treasury reduction amid diversification constitutes a foundational shift in global finance, with indicators necessitating fiscal and diplomatic recalibrations to mitigate funding volatility and rollover complexities. As December 26, 2025, marks the release of the latest Treasury International Capital data for October, the shift in auction demand toward domestic buyers signals profound structural changes in the U.S. Treasury market, raising alarms about long-term financing sustainability amid persistent fiscal deficits and evolving global capital flows. This transition is critically important at this moment because recent Treasury auctions throughout 2025 have exhibited solid overall bid-to-cover ratios averaging 2.530 for longer maturities, yet indirect participation, often indicative of foreign demand, has fallen below historical norms of 40–50%, as domestic dealers and funds absorb larger shares amid caution from overseas investors. Embedded within a macroeconomic landscape where U.S. deficits have exceeded 7% of GDP for the year, driven by sustained spending on infrastructure and defense, this domestic tilt points to higher relative yields needed to compensate for fiscal uncertainties. compressing liquidity premiums as the 10-year Treasury yield holds above 4.1% despite Federal Reserve rate cuts to 4.25450%. Markets are interpreting this through stabilized short-term rates but elevated long-end yields, anticipating sustained domestic absorption that could strain private Sector funding, geopolitically, declining foreign bids tied to de-dollarization trends and trade frictions, prompting allied holders like Japan, whose positions remain stable at around $1.1 trillion, to maintain but not expand commitments significantly, as BRICS nations accelerate multi-currency settlements, reducing dollar reliance by 10–15% in trade flows. The underlying danger involves a permanent elevation in borrowing costs, potentially adding 0.305% to GDP and interest burdens over time, equating to hundreds of billions annually. As this constrains policy space and amplifies vulnerabilities to external shocks in a fragmented global financial order marked by Middle Eastern tensions, sustaining Brent crude near $75 per barrel and moderating global growth below 3% for 2026. Historical precedents show that shifts in Treasury auction demand toward domestic buyers have often foreshadowed periods of heightened borrowing costs and financial stress, as evidenced by the 2013 taper tantrum, when the Federal Reserve's signal of quantitative easing reductions led to a 100 basis point spike in 10-year yields amid reduced foreign participation. Or the late 2010s trade war era, where China's Treasury sales contributed to auction tails widening by 10–20 basis points as foreign indirect bids dipped below 40% in longer maturities. In those cycles, policy failures, such as over-reliance on foreign capital inflows without fiscal consolidation or inadequate preparation for de-dollarization signals from emerging markets, allowed domestic absorption to compress liquidity premiums, with European and Japanese holders maintaining positions but not expanding amid geopolitical frictions, leading to interest burdens adding 0.20% to GDP over subsequent years. The 2025 shift, however, is structurally more dangerous due to the unprecedented scale of U.S. issuance, exceeding $2 trillion quarterly, and foreign caution amplified by de-dollarization trends, where BRICS efforts have promoted multi-currency settlements in 20–25% of intra-block trades, surpassing the 10–15% levels during the 2010s euro crisis when similar diversifications elevated U.S. yields by 50 basis points. Unlike earlier periods where allied holders like Japan expanded positions to offset reductions from adversaries, today's geopolitical frictions, including trade measures that have prompted China to reduce holdings to $688.7 billion, the lowest since 2008, foster a more fragmented demand base, as indirect participation in auctions averages 35–40% for 30-year bonds in 2025. Below the 45–50% historical norms, rendering the market more susceptible to permanent cost elevations without the stabilizing foreign buffers of past decades. Delving into the data and mechanisms, the demand shift originates from recent 2025 auctions, where overall bids remain solid with cover ratios at 2.6 for 10-year notes in November, but indirect foreign participation has averaged below 40% in longer maturities like 30-year bonds. As domestic dealers and funds take larger primary allocations amid foreign caution, reflected in the October TIC net outflow of $37.3 billion in long-term securities. Step-by-step economic rationale transmits through fiscal uncertainties. Deficits over 7% of GDP require issuance that compresses liquidity premiums, necessitating higher relative yields, 10-year at 4.1%, to attract domestic capital as foreign bids decline, tied to de-dollarization, where BRICS multi-currency settlements reduced dollar trade usage by 10–15%. Capital flows interlink with rotations, as institutional funds absorb more treasuries domestically, elevating auction tails by 5–10 basis points. Debt dynamics intensify, with rollovers for $35 trillion in obligations facing costs adding 0.305% to GDP burdens over time. Inflation at 2.7% core interplays by eroding real yields, prompting further foreign caution as labor market softness at 4.6% limits growth that could offset deficits. Policy logic sustains the shift. Geopolitical frictions, including trade measures prompting Japan's stable $1.1 trillion holdings without expansion, tied to de-dollarization amplifying vulnerabilities to external shocks in a fragmented order where allied relations strain under shared pressures. Market interpretations are evident in pricing signals, with short-term rates stabilized at 4.33% effective federal funds, but long-end yields elevated to 4.1% for 10-year notes, anticipating domestic absorption as auction tails reflect premium demands from reduced foreign bids and maturities beyond 10 years. Equities in rate-sensitive sectors dip 1–2% as higher yields compress valuations. Currencies show the dollar index at 98.92, moderated amid trade frictions. Commodities like gold rally 10% as hedges. Institutional investors view this as structural cues, realica. Ting towards shorter maturities with inflows of $25 billion quarterly, interpreting de-dollarization as amplifiers of downside for long-end holdings. Markets lead by processing auction data, spiking swap spreads before results, enabling de-risking that embeds potential GDP additions of 0.305% in burdens. Authorities navigate constraints, able to refine auction processes or engage diplomatically to encourage foreign bids, but cannot reverse de-dollarization without deficit reductions, as interventions risk inflation to 3.2%, damaging credibility amid political debates. Credibility risks from elevated tails could widen spreads by 40 basis points. Trade-offs involve stability versus restraint, yet easing averts elevations but entrenches dependencies. Spillovers vary, with the United States facing interest burdens adding 0.4% to GDP. China leverages diversification but risks volatility. Russia and BRICS advance multicurrency, fragmenting by 12%. Europe endures yield increases, necessitating aid slowing growth. Emerging markets suffer outflows of $200 billion, elevating yields by 200 basis points, mismatches amplified. Financial consequences include volatile flows, overburdening facilities by 18%. Escalation reinforces via loops where declining foreign bids widen tails, elevating yields and prompting further caution, constraining space as shocks amplify. Second order, domestic absorption reduces lending by 7%. Third order, equity contagion falls multiples by 8%. Triggers include deficit expansions or frictions in Q1 2026. For 2025-2026, short-term sees stabilized demand if truces hold, yields peaking at 4.3% by mid-2026. Medium-term, structural changes, foreign shares dropping 5%, slowing funding. Power, U.S. wanes as BRICS gain, eroding reserves by 6%, emerging phrase, unrest. Architecture hybridizes, lags extend risks. In conclusion, auction demands shift to domestic buyers signals structural transformations, evidence necessitating fiscal and diplomatic recalibrations to mitigate borrowing elevations and vulnerabilities.